They say real estate is about location, but when you're putting $100,000 on the line, it's all about the numbers. You can love a neighborhood. You can believe in a city. But if the deal doesn't cash flow, you're not investing. You're speculating. In this episode, I'm breaking down the exact framework I'm using to analyze my first real estate deal. This isn't a hypothetical. This is me walking you through the property type, the asking price, the expected rent, the expenses, and most importantly, the return. My goal is simple. Turn $100K into cash flowing income that lasts. And that starts with the numbers. So let's dive in. The deal summary. The deal summary. This is a real 3-bed, 2-bath duplex in one of the top cities on my shortlist. Asking price, $178,000. Rent per unit, $1,050 month. Fully occupied, built in 1990. Each unit is separately metered for utilities. Basic condition, no major renovation needed, just cosmetic refresh, so we're looking at $2,100 gross rent monthly or $25,200 annually. But that's just the starting line. Here's where most beginners make a mistake. They look at the rent and ignore the costs. I don't do that. I break it down using what I call the 7-layer deal filter. Layer 1, acquisition cost. Asking price, $178,000, but I'm not paying that. I run comparables in the area and negotiate based on cap rate, not emotion. Target offer, $170,000 plus closing costs, $5,000 plus inspection and appraisal. $800, total $175,800 all-in acquisition. I plan to use 25% down. That's $43,950. The rest is financed. A $131,850 mortgage. Loan terms I'm using to 7% interest, 10 year fixed monthly mortgage. To $877,50,000. Layer 2, monthly income. Total rent $2,000 month. But I assume 1 month of vacancy per year per unit. That's 2 months total. $200,000 to 12 is $350 month lost. Adjusted gross £1,750 month month average. Layer 3, monthly operating expenses. Let's break them down. Property taxes, $220 month. Insurance, $100 month. Repairs and maintenance, $150 month. Capital expenditures, $150 month. Property management, 10% of gross rent equals $210 month. Vacancy allowance already baked in. Utilities, tenants pay all HOA, none. Total operating expenses, $830 month. Layer 4, monthly net operating income, NOI. Adjusted rent, $1,750. Expenses, $830. Net operating income, $920 month. This is before mortgage. Layer 5, cash flow after debt serviced. NOI, $920. Mortgage, $877.50. Monthly cash flow, $42. Fee. Now pause here. Most people would say, that's not worth it. But this is where it gets interesting. That $42.50 is on a conservative model. It assumes full property management. It assumes 2 months of vacancy. It assumes consistent capex and maintenance. But here's what happens. If I self-manage the first year, tenants renew with no vacancy, minor repairs only. That same property could cash flow $300 plus per month in year 1. And even if I stick to the conservative $42.50, that's positive cash flow from day 1. I'm not losing money to own the property. Layer 6, cash on cash return. Let's say year 1 cash flow ends up at $2,400. Realistic with some management efficiency. Cash invested, $43,950. Return, $2,1400. Cash on cash return, 5.45%. Not mind-blowing, But here's the deal. This is only year 1, and it gets better. Because of loan paydown, rent increases, and tax benefits. Layer 7, long-term upside. This is where the real wealth builds. Mortgage paydown, $2,000 in year 1. Annual rent increase, 3 to 5%. Property appreciation, even at 2%, $3,400 year tax depreciation benefits. £2,500 tax shelter. When you add it all up, my total economic benefit year 1 is more like $8,000 on $43,150 invested. That's an 18.2% total return. And that's conservative. But let's zoom out. Would I buy this deal? If this is the worst case outcome, yes. Because here's my logic. It's stable. It's cash flowing. It's low risk. It gets stronger every year. It builds equity. And I can refinance in year 3 to pull equity and scale. Financing tip. If I refinance this property after 3 years at 70% LTV with $15,000 equity gain, I could pull out $12K, $15K tax-free. Then roll it into deal number 2. That's the snowball. I'm not trying to get rich overnight. I'm trying to build a system that multiplies. Now let me tell you why this deal almost scared me. I was worried the cash flow looked too low. I compared it to people flipping and making $50K a month. I questioned if this was too slow, but that's exactly why I'm doing this publicly. To show you the real math, not hype. The discipline behind wealth, not the dopamine rush. Because 42 to 50 month today might look small, but it's $500 a year. Add 10 of these deals, now it's $5,000 passive income. Add leverage, you start seeing 20K plus wealth creation annually with cash flow. And in 5 years, that turns into multi-property equity. That's the goal. I'd rather have 10 slow wins than 1 fast loss. So here's the summary. Property, 178K duplex, cash needed. 43,950, cash flow. £42,300 month, depending on management. Realistic COC return, 5 to 6%. Total return, including equity, tax, appreciation. BOJ 18%. Refinance potential in 3 years, scalable, repeatable model. Would I buy this? If I had to pull the trigger today, yes, because the numbers work without fantasy. This isn't a flip. This is a foundation. Final thought. If your deal only works in perfect conditions, it's not a deal. If it only works with 0 vacancy, no repairs and appreciation, it's a fantasy. But if your deal works in real conditions, even modestly, you've got a portfolio. That's what I'm building. Deal by deal. Brick by brick. Comment below. Would you buy this deal? What would you change? Subscribe to follow me in real time as I get closer to deploying this 100K. Affiliate book of the day, The Millionaire Real Estate Investor by Gary Keller. Next episode, I meet with a local agent and walk through a property I'm seriously considering. You'll see the actual numbers and what I do during an in-person walkthrough. Let's keep building. This is Dropout Investor. Real money. Real analysis. No hype.